Thank you, Ryan. So today we are, as Ryan said, we are covering tax law changes for 2014. Now, 2014 was a more subdued year as compared to 2013 in regard to U.S. tax law changes. So in addition to what changed, we'll also be covering some points that we feel that U.S. taxpayers should be aware of when they're filing their tax returns. So, and to begin, the general disclaimer, the information presented here is a general guide in applying to your own individual tax situation. Please consult with your tax advisor. So for our agenda, we are planning on covering the increases to the foreign earned income exclusion and foreign housing exclusions. We'll talk some about the foreign reporting forms. Go over the updates to the Streamlined Program that's currently going on with the IRS. We'll talk a little bit about Form W-8 Ben, cover some about U.S. and Japan Social Security planning, talk about the new healthcare coverage requirements, and then at the end, we'll go over some hot topics. We won't be going over every point and every slide because we want to leave time for questions at the end. So if you do see something that's on the slide but we haven't gone into in detail, feel free to ask a question. Okay, to begin with, the foreign earned income exclusion and foreign housing exclusions. So this is one of the chief mechanisms that under U.S. tax law that is used to alleviate the double taxation that U.S. taxpayers are subjected to by virtue of the worldwide nature of the U.S. tax system and then being subject to, in this case, Japan tax by being resident in Japan. In 2014, the foreign earned income exclusion is increased to $99,200, and in 2015 it goes up again to $100,800. The foreign housing cost limitations are also increased, as well as the geographical limitations. For 2014, the geographical limitation for Tokyo is $96,000, which is down from 2013. So what that means is for a taxpayer living in Tokyo claiming the maximum exclusion would be $179,328. A word, though, on the exclusions, the foreign earned income exclusion and foreign housing exclusions. As many of you may know, prior to 2006, the exclusions were a very good deal. So basically, you would get the exclusions, and then the first dollar of income beyond the exclusion was taxed at the very lowest U.S. tax rate. And in 2006, the tax law changed, and so what happens is you still get the exclusions, but the first dollar of tax beyond the exclusion is taxed at the tax rate that would have been in effect had the exclusions, had that income not been excluded. Essentially what this means is the exclusions use up the lower tax rates for U.S. taxpayers claiming them. So whereas before 2006 it was a no-brainer, you claim the exclusions and then you claim the exclusions on your tax return, became a bit more challenging after 2006. It wasn't always advantageous for U.S. taxpayers to claim the exclusions. But the problem is once you claim the exclusions, if you revoke them, then you cannot claim the exclusions for another 5 years. So there's some planning involved if you plan on revoking it. If you came over after 2006, this is still something you probably want to look at because very often what happens is in the first year, the exclusions are beneficial. After that, they're not necessarily beneficial. So this is something you may want to look at when filing this year and discuss with your tax advisor. Okay, moving on. Foreign reporting forms. So to begin, there's the new new in 2007 Form 8938. This was brought to us by FACTA, which basically required U.S. taxpayers with specified foreign financial assets over a certain threshold to disclose those assets to the IRS. Now, what is a specified foreign financial asset? It's a financial account maintained by a foreign financial institution. It doesn't include a U.S. branch of a foreign institution or foreign branch or subsidiary of a U.S. institution. The thresholds begin at $50,000, but are higher for taxpayers living overseas. For a single taxpayer living overseas, it's $200,000 on the last day of the year, $300,000 at any time during the year. And this slide outlines the thresholds for various taxpayers and tax filing statuses. Now, if you don't have to file a tax return, then you don't need to file this form. But although there's no tax associated with this form, there are significant penalties with not filing the form, which begin at $10,000 for failure to disclose and go from there. In December 2014, the regulations surrounding this form were finalized. This slide goes over some of the things to be aware of. But the main takeaway is that the finalized regulations did not differ substantially from the temporary regulations. So not much change from filing in 2013. Okay. Moving on, we'll talk about the brother to this form, the Report of Foreign Bank and Financial Accounts. Whereas the Form 8938 had higher filing thresholds, this one needs to be filed if a U.S. citizen or a resident alien has a bank account or accounts that singularly or cumulatively exceed $10,000 at any point during the year. A question that we often field is, so if you have one bank account and you have $11,000 in that for any time during the year, you need to file this form. A question that we often get is if you have a bank account with $5,000 and a bank account with $6,000, well, neither of them exceed $10,000, but cumulatively they're $11,000, so you still need to file the form. The filing date for this form is June 30th. There is no extensions, and now it needs to be filed electronically online. No real changes for this form for 2014, but this is one that often catches people up. Okay, moving on. So, Streamlined Program. So I'm sure everybody in this room is current with their 1040s and FinCEN 114s, and so this is not a great concern, but for those of you who have friends who are not current, have been talking to our European colleagues, the IRS is currently running a program called the Streamlined Program. And during 2014, they expanded this program. What this program is it's available to taxpayers who failed to report foreign financial assets. And what happens is you need to file 3 years of back tax returns and 6 years of back FinCEN 114s. The key to getting into this program, however, is it must be due to non-willful conduct. And non-willful conduct is conduct due to negligence, inadvertence, mistake, as it's spelled out on the slide. In other words, I didn't know I had to file, or my accountant told me I didn't have to file. In other words, you didn't purposely not file your tax returns. Tax and interest are due with the filing. Under the expanded program, you can now file Form W-7 to file jointly with your spouse. And there is Form 14653 that needs to be filed with those tax returns. So non-filers and filers with unreported income are eligible, and it's not applicable to those without unreported income or 1040 NR filers. This is a really valuable program for if people are out of the system. It's a way to get in and get clean. We have had several people that we've gotten through the program, and it's very valuable. All right, I'll turn it over to Clayton to talk about Form W-8, Ben.
Which way do you press it to go forward? Okay. Thank you, Paul. Kind of want to get a feel. Has anybody here actually seen W-8 Ben form before? Raise your hand if you've seen it before. Of course, Nasir, yes. Marcus. So actually, that's a little bit more than I'm expecting. So I kind of don't like to make assumptions, but I get the feeling that there's a lot of maybe U.S. citizens and green card holders here. And if you are one of those individuals, you might not have seen this form or needed to file it before. But if you do have maybe, for example, a foreign spouse, or you are a foreign individual yourself, not really a U.S. person, there is a reason you might see this form. So that's kind of why we want to cover it today. So a brief overview. If you're a foreign person for U.S. tax purposes, you are subject to U.S. tax, generally at a 30% rate on income, including interest, dividends, rents, royalties, premiums, and annuities. And if you are an individual who is in a country that has a tax treaty with the U.S., such as Japan, you're living in Japan, there's actually a way for you to reduce this automatic withholding requirement on your U.S. income. And that's kind of where this W-8 form comes into play. So what is exactly this W-8 form going to do? It's very important to know that this form is going to be filed not to the IRS, but to the relevant distributor of the income. And what you're telling that distributor is that you are not a U.S. person and that you are the beneficial owner of this U.S. income. And then if applicable and you meet the requirements for the treaty, you can generally apply a much reduced or even exempt tax rate on your U.S. income by filing this form directly with the distributor of the income. Once you file this form, it's valid for the next 3 years, so you won't have to file it every year. And we do want to reemphasize that you only file this with the payer of the income, because even the IRS knows that there's been phishing scams, people trying to get your information. They'll send you a fake W-8 BEN, ask you to file it with the IRS, which is actually just them. And then they'll ask you for information you don't need to provide, like your passport ID, maybe your PIN numbers. So we want you to be careful of that form if you see it. This is the form, just for your reference. We're not going to go through this form, but it's just kind of to show you what it looks like. It's just a one-page form you file. And somewhat related to this form is a W-9. So if you yourself are not a U.S. person, you're going to file probably W-8 BEN. If you are a U.S. person, sometimes they need to get your information for filing, like, for example, a 1099 to the IRS on your behalf. They would get your information through a W-9. So again, this is something that you would file not with the IRS, but with the payer of your income. And you do want to be careful that it is a legitimate request and you're not getting sent a fake form so you don't get phished for confidential information. Okay. Next, I'd like to move on to some U.S. and Japan Social Security planning items. So I guess a general background of Social Security, the way it generally works is you enroll into a program, your country's Social Security program, and just enrollment alone is not enough to reap the benefits. You generally have to qualify to get the benefits, and depending on what country that is, the qualifications will change. For example, the U.S., to get retirement benefits from Social Security, you need to have a total of 10 years of service. They count it in credits. You might hear 40 credits, but every credit is essentially a quarter of a year. In Japan, it's currently at 25 years, so it's substantially larger. So there are some problems that happen to people who are essentially working a career in 2 or more countries, because you might work not enough. You might not work 10 years. What if you work 8 years in the U.S. and then you retire? If there's nothing in place to help you kind of combine and totalize these years you've been putting in working in different countries, you're kind of at a loss. So that's kind of what this whole totalization agreement is. It's something that will help you totalize the time you've worked for 2 different countries under this totalization agreement, and it'll help you use, for example, your Japan working years to qualify for U.S., and likewise using your U.S. years to qualify for the Japan system. So for example, I could work 5 years in the US, then work 10 years in Japan, and for that example, I would qualify for essentially 15 years of, or at least I would have 15 years in terms of qualifying for the US plan and be able to get at least a fractional benefit because I did put in less money to the US plan, but I would still at least be able to qualify. So that's kind of what this agreement is helping you with. Another thing it does is it helps kind of provide guidance on which country you should be paying into specifically. They don't want you to be paying into double countries. You should not be getting double taxed on Social Security payments. So that's kind of the two purposes of this agreement. An important thing to note is that Medicare is actually not covered under the totalization. So if you work 5 years in US, 10 years in Japan, you still do not qualify for Medicare because they're only going to count the US side, the 5 years. This totalization agreement first came into place on October 1st, 2005, and 2010, October 1st, it signifies the first 5 years that that the agreement was in place. And this is important because the agreement initially allows for individuals who came from the US, for example, to stay on US Social Security and keep paying into US and not paying to Japan, right? But if you're here for more than 5 years, unless you get a specific extension, you cannot continue to pay into the US system. You have to switch. So, you know, if you're still paying into the US system, you might not, technically you're probably not supposed to unless you got a specifically an extension on it. There are some differences between what system you pay into. So, for example, the Japan system, if you are not an employee, if you're, for example, maybe being paid offshore, if you're not a Japan paid employee, if you're either self-employed or you're paid offshore, you might be able to only contribute up to 997,080 yen per year into your program. Whereas if you're familiar for the US side, well, Social Security is capped, but Medicare has no cap. So the more income you earn, realistically, US is going to be more expensive to be paying into that system. And additionally, they added a 0.9% for what they consider high-earning individuals in 2013, so the Medicare rate went up essentially from 1.45 to 2.35, provided you're in that income bracket. The enrollment process is fairly simple. What you do is, if you are supposed to be in the Japan plan and you need to show to the US side that you are already enrolled in this other plan, you would get a certificate of coverage from the country where you are actually making payments into. If you're self-employed, you can then copy that certificate of coverage and attach that to your tax return to substantiate that you do not need to pay self-employment tax, which is essentially both employee and employer US Social Security and Medicare payments. Lastly, you should note that the system, if you want to qualify for each, even if you meet the combined total, for example, if you meet the 10 years in US and Japan, say I work 1 year in the US, 9 years in Japan, I might qualify under regular circumstances, but I do need at least 18 months of working in the US system. So in that particular scenario, I would not have qualified. Japan is much more lenient, you only need 1 month. Now I'd like to move on to some new healthcare coverage requirements. You probably know this as Obamacare, and you might or might not be aware, but it is coming into effect on your tax return from 2014. So, beginning in 2014, individuals have to have healthcare coverage or be exempted from healthcare coverage or make a shared responsibility payment, which is basically a penalty, and you would pay that with your federal tax return. Some exemptions are available from the marketplace, which is the name of where you would go to get your insurance claims. And some of them can be claimed on your tax return, filing specifically 8965. So if you are required to file a tax return, you would just file 8965 as just like another form you file with your tax return to claim your exemption from the Obamacare requirements. Let's look at the general scope of Obamacare. So there is a minimal essential coverage that you need to be aware of. That's saying you need to have, I mean, most types of insurance are going to meet minimum essential coverage. So it's basically saying you need to have some form of health insurance. It is mandated to U.S. citizens and residents, so that would include green card holders. But it does not apply to non-resident aliens, at least until they become a U.S. resident. There's a number of different types of exemptions. We're not going to really cover all those because we don't have enough time, but you can go to Form 8965 instructions to figure that out. And there are some penalties depending on what year you are not meeting the minimal essential coverage or being exempt. And that's just outlined here. So let's take it a little closer to home. What does it mean for individuals such as yourselves, who I assume are living in Japan full-time? How about if I am insured, by the national Japanese health plan? Well, in general, any insured coverage regulated by a foreign government is deemed to meet these requirements. Currently, that includes Kenko Hoken Kumiai and Kyosai Kumiai. Technically, still they are confirming whether Zenkoku Kenko Hoken Kyokai is going to be covered. But in general, it seems like they're going to allow your payments or your enrollment into the Japan National Plan to qualify. Another way to get around having to pay this penalty is that if you are a U.S. person living abroad and you have either bona fide residence in your foreign country, which would be Japan in this scenario, or you're present in Japan for 330 days out of 12 months, then you can apply for exemption, and that's something you would claim on Form 8965. You'd mark letter C to indicate that you qualify, and then you would not have to meet the MEC requirements. You would be exempt. And if you are not familiar with these two requirements, it is the exact same requirements to meet for the foreign earned income and foreign housing exclusion, which Paul was talking about at the beginning of this presentation. This is just a quick clip of the form. And this is what you would use to claim any exemptions for yourself or another member of your tax household. And it will be filed together with your tax return. But if you just meet already the minimum essential coverage requirements, then there's just a box you tick on the second page of 1040. Okay, I'd like to move on to some hot topics. This is a general overview of what we want to cover. There's been an increase in the U.S. United Gift and Estate Tax Exemption. There is the proposed Japan exit tax most likely coming into place. There is a budget proposal in the U.S., which Paul will cover. And there's also a report on tax reform from the Republican staff of the U.S. Senate Committee on Finance. So, last year, 2014, the U.S. and estate tax exemption allows you a $5.34 million unified tax credit. Well, not a credit, but they calculate the credit based on this amount. So essentially, it's an exemption. That went up to $5.43 million, so almost a 100,000 increase for 2015. For both 14 and 15, the annual gift tax exclusion remains at $14,000. However, if you have a non-citizen spouse, as you may be familiar with, you do not get the unlimited gift privilege, but you can gift up to $145,000 for 2014, and it went up to $147,000 for 2015. On the other hand, 2014, Japan went the exact opposite direction. They lowered the exemption from $50 million to $30 million for inheritance tax. The dependent exemption went down from $10 million to $6 million, and they increased the top tax rate from 50% to 55%. The actual gift tax exclusion remains at $1.1 million for both 14 and 15. So what does this mean? If you've done U.S. planning already, and you haven't looked at the Japan side and you see yourself here for the foreseeable future, that is something you want to look at, because Japan is getting more aggressive on collecting inheritance tax, and they have much lower thresholds on what would capture you under inheritance tax. That's mostly what I want to cover. Now I'd like to pass it on to Paul.
Okay, so this is the truly hot topic of the moment, the proposed exit tax that's still being debated but expected to be passed by the Abe administration. And if this is passed, it's expected to go into effect on July 1st of this year. The affected individuals are Japanese nationals and foreign nationals holding certain visas, resident in Japan for 5 years out of the last 10 years prior to departure, and hold 100 million or more in certain financial assets. Those assets would include appreciated stock, interest in partnerships, et cetera. And basically what the tax does is it deems a distribution of the certain assets, or not distribution, disposition of the certain assets, and subjects them to a 15.315% tax. It's possible to get an extension of paying the tax if you appoint a tax administrator, and it can be extended up to 5 years. And then after that, another 5-year extension is possible. But that also subjects you to gift and inheritance tax during that period. Now, for U.S. taxpayers, this is not quite as bad as others because of the worldwide nature of the U.S. tax system. You would pay the exit tax and be expected to get a foreign tax credit on the U.S. side. However, this is still a bit challenging because there's a 10-year carry-forward period. Well, basically, foreign tax credits carry forward for 10 years and then expire. So if you don't use up this credit within the 10-year period, then it could expire. And there's also questions about whether the income from disposition of that asset, when it's later disposed of, would be considered foreign source and eligible for the foreign tax credit. And whether the gift and inheritance tax would apply to during the deferral period to non-Japanese. There are planning, this tax is still in proposal stage, but there are planning ideas around this, such as trying to dispose of enough assets to get under the 100 million threshold. That can be a bit tricky, however, because what would be a small gain on the U.S. side or a loss, for example, could be in a large gain on the Japan side just due to FX changes. Or in the original, when this proposal was originally announced in December, the visa types that they thought said it would apply to were spouse visas and permanent resident visas. If you look at the actual law right now, it says basically that the visa types will be spelled out later. We don't expect it to change, but so a planning idea would be to change the visa type and try to get out from under the exit tax. But the basic takeaway is if you, after the law is passed and you find yourself subject to the exit tax, you should talk to your tax advisor and try to do some planning to minimize the effects. Moving along. These are a couple things that have been appeared in proposals, but not legislation. So in the latest Obama budget, there was a proposal for potential relief for U.S., essentially what are called accidental Americans. These are people who either were born in the U.S. but have moved outside when they were very young, or people who are born to U.S. Citizens outside. Who have never filed a tax return. The proposal would essentially exempt them from the exit tax. So far, no legislation's been introduced around this proposal, but it does show that there's some awareness in political circles. In addition, under the Comprehensive Tax Reform for 2015 and beyond by the Republican Staff Committee of Finance for the U.S. Senate, There was an interesting discussion on how the worldwide, the U.S. is the only country that subjects its citizens and residents to taxation on their worldwide income. And in that report, there was a discussion on moving towards a residence-based taxation and what that would entail, such as introducing a test on whether when a person would no longer be subject to U.S. tax, and then if they moved back, when they'd again be subject to U.S. tax. Not free, because in the same document there was also there was a point on highlighting the necessity of introducing an own exit tax under such a system. Again, no legislation's been introduced around this, but it does show an awareness of expat tax issues in political circles, so let's see if it goes anywhere. Any questions?
Thanks, Tom, and thanks, Paul. We will take some questions. I'd just like to make one point before we do, which I think is important to note. The exit tax, the Japanese exit tax, which you heard a lot about, even though it's new and it's coming in very soon, not much time to plan, it is actually a narrow band of taxpayers. You need to be on a PR, permanent resident, or a spousal visa. The Japanese normal income tax applies only to those who've been 5 years or more. I think the important thing to note for those of us who are foreigners in the room is that the inheritance tax applies to anybody, even if you haven't met the 5-year rule. And this is something that the Taxation Committee is going to be taking up in a viewpoint later this year, because that's quite aggressive when the Japanese income tax doesn't cover. So just be aware of that. That their inheritance tax law does apply to anybody in Japan working, even if you are not yet subject to Japanese income tax. So now we'll take questions. We have microphones. Nakano-san has a microphone. Yes.
Just two questions. One, on page 25, you talk about the certificate of coverage. Where does one obtain a certificate of coverage? This is with respect to the offset for Social Security plan.
Hello? You would be able to go to the ward office to get that?
Just the ward office?
Yeah.
And the other question is hot topics, the proposed exit tax, page 34. It mentions financial assets, so do you mean real estate is excluded? Perhaps I missed that in your comments.
Real estate is excluded under the exit tax. Under the current proposal, real estate is excluded.
Thank you.
Sorry, just let me repeat that, because some of those on the webcast audience may not have heard. If you hold the real estate personally, it's exempted, but if you hold it in a corporation, then it becomes financial assets.
Yes, on slide 17, the Streamlined Program updates.
Yep.
Does not applicable to those without unreported income use different procedure?
Yep.
What is that procedure?
So if you look, I believe it's in the frequently asked questions to OVDI, which is a Overseas Voluntary Disclosure Program. It says that if you have not, if the income's declared but you have merely not filed the foreign, the FinCEN 114, you wouldn't be subject to the penalty. I think there's specific wording that needs to go on your filing, but I can't remember what that is right off the top of my head. So basically, you'd still need to file the FinCEN 114, but with specific wording, but you'd be exempt from the $10,000 penalty.
Is the wording in the frequently asked questions as well? Okay. So the frequently asked questions are on the website, on the
IRS website.
On the IRS website.
I have a question on the Social Security planning. If someone has like 20 years
Right.
work experience in the U.S., say 15 here,
Yeah.
could you shift the 10 here and then qualify for both?
Oh, so I should clarify, there's no shifting. What happens is Japan will recognize your U.S. years in terms of qualifying you for 25. And then from there, it's going to depend on how much you actually paid into the system in Japan. You're not going to get payment out from Japan for what you paid into the U.S., but you will get at least qualified.
Okay. And then is there a form I need to fill out, or, if that?
Yeah,
the
there,
case?
if you go to the Social Security Administration website, SSA. I forgot the last part of that. If you go to the website, they have specific links of where you can go and who you can talk to.
We
but yes,
assume ssa.gov.
Let's assume Gov.
Okay, thank you.
Are you prepared to take any questions on the inheritance tax issues?
If
Yeah, if Tom and Paul can answer, we'll give the mic
Okay.
to Harish, yes.
Typically, as I recall, the life insurance proceeds in the U.S. bypass inheritance. They're not part of the estate. But I believe that life insurance proceeds, no matter where they're paid out, are part of the inheritance in Japan. Is that correct?
you mean for Japan inheritance
For
tax?
Japan inheritance.
It's not exempt, but you do get an exemption for life insurance proceeds. I believe it's up to 10 million now. 5 million per
5
year.
million,
5 million per
5 million yen.
Yes.
So if you have $1 million life insurance policy in the U.S., kick the bucket, that goes into your estate as far as
If you are the
Japan's estate.
policyholder, the
So the
beneficiary, yes.
55% of that would be payable to Uncle Abe.
Uncle Abe would try to get a piece of that, yes,
Okay.
after giving you the exemption.
Or if your spouse is the owner of the policy.
Or if your spouse is owned.
And the trusts are not recognized in Japan, right?
Trusts are not recognized in Japan.
I apologise for those on the webcast. We may not be able to capture all of the discussion off the mics, but we'll do the best we can.
My employer in Japan has a defined contribution retirement scheme, basically Japanese 401k. For reporting purposes, is that considered a specified foreign financial asset or a financial account that has to be reported like your other bank accounts? What's the treatment or the general thinking on that?
Yes, you need to disclose that.
Are there any other questions?
Just a follow-up question on the exit tax, and specifically relating to the real estate exclusion. Real estate held in a corporation would not be excluded. What about an LLC, LP, or GP? General partnership, limited liability company.
Yeah, my understanding is it would be included under under financial assets.
For
So-
all three of those?
Yes, a partnership, interests in partnerships, interests in LLCs, those are all covered. So unless you actually hold the real estate personally, that's essentially the only exemption, which I understand is because this law was designed for Japanese nationals, and most Japanese people own a house in Japan. And if they leave, you can obviously, they have to sell it if they're leaving permanently usually, so that's why that real estate's excluded. But if you've structured it in a way through some other kind of structure that other than personal holding, then it would be captured.
The clarification on that would be that LLC, very certain, very clear, at least under the existing rules. LLC, we not that clear because there is litigation going on, and that's not really
Up to be determined in the maybe next 2-3 years, once it goes to the High Court or if they make the legislative change. So that's the uncertainty there.
I think the thing to be careful of is that, or to be aware of and to check, is that Japan doesn't have a lot of the kind of estate structuring tools like trusts and partnerships and things that you may use in other countries. So it's always a question about how they're going to be classified. So that's where the problem arises.
Question on how tax is applied to, in Japan, what is called either a retirement or a pension paid directly out from a company. recently I've been advised that a retirement allowance from a corporation to an individual in Japan is taxed, I think, at roughly about half the amount of normal income, whereas in the United States it's considered to be regular income and taxed at the full amount. Is this unfortunately correct, or?
Yeah, you're talking about taishokin?
Yes.
Essentially, yes, that is correct.
And there's really no way around that?
Depending on your situation, there is some planning that can be done.
But if it's not been planned on long before, you're kind of stuck with regular income?
The treatment isn't going to change. There is some, you can take a look at your foreign tax credits to see if there's something that can be done there.
Thank you.
On page 33, it's talk about gift exclusion. 14,000 is general, but 145, 147. What's the?
Oh, for the gift to non-citizen spouse?
Yeah, and what is the 14,000 referred to then? Annual gift tax exclusion is 14,000, but to a spouse it's 140,000.
Correct.
Okay, so your son is.
Your son can get 14,000
okay.
from you, 14,000 from your wife. If your non-citizen spouse is going to get a gift from you, it has to be limited to 147 for that year.
And you have to declare this somehow? I mean, if you're filing joint?
No, this is the exemption where you wouldn't have to file.
Okay.
If you exceed that, then you would need to file to
okay,
dig
alright.
into your unified tax credit.
Okay, thanks.
Another question here.
On the exit tax, other than if spousal visas and permanent visas are the two categories that subject you to that tax, what are there preferred alternatives to, is it to get a employer-sponsored work visa? Is that the solution? Or?
When the proposal was initially announced, yes, those visas were exempt. If you look at the actual law as it is now, it's just going to be spelled out later in probably an administrative order. But we wouldn't expect it to differ from what was announced initially.
And then if one was to decide to make that change, do we need to complete that before 7/31, before the law takes effect, or?
That's not yet clear, I think.
At this point, that is not clear. That's kind of one.
Maybe as soon as possible is the answer, if that's your planning option.
Thank you.
There may be some, you may have seen the EBC published an article on this. There may be some transition rules that have not been publicly announced by the government, but so there may be some time limit, but at this stage, July 31st, you should treat as trying to work out your plan before that date.
My immigration advisor advised me to retain permanent residency because that was considered the highest form
Yes.
from a immigration standpoint, but tax, not considering the tax
Yes.
implications, but.
That's absolutely true, and I would say this exit tax has caught a lot of people who are here on spousal visas, which were previously easier to get than work visas, or have become permanent residents, caught them by surprise.
Okay, thank you.
Commenting on the last issue, I think you can eat your cake and have it. If you don't have permanent visa, your mortgage application in Japan is probably not going to be approved from the banks. So you need to make a decision as to whether to give it up or not in that case. Now my question is, my understanding...
Or you could hold, you could sell some assets, hold less than 100 million assets.
Okay. Yes. My question is, my understanding is that in the past in Japan, you had a Y case, and if you make a loss as a YK owner and you are a US citizen, you could take that loss on your individual tax return in the US. Is that still the same with GK now that we don't have new YKs but special YKs?
I'm not sure of the treatment of GK for individual taxes here. Right. So the answer is if you've checked the box, yes.
Some of us happen to have indigenous or Japanese spouses. I happen to have a Japanese spouse. And at least in my case, her money is her money and my money is her money.
The US government doesn't think so.
That's probably true anywhere in the world. But it would be useful in explaining this if you had this material prepared in Japanese as well. I don't know if you're planning to put this in Nihongo, but I would find that very useful, if that's possible.
We will take that on board, and if we can, and if it can be uploaded on the website, we will see. We'll have to see if we can do that. Are there any other questions?
A simple one. Gift tax exclusion in Japan, there's no spousal limit, which is different from the general limit, or?
No, there's no, you mean exclusion, I suppose? Only on inheritance tax, there's something called a spousal credit, which you can take, which will give you some relief. But gifting to your spouse, you don't get more than the 1.1 million.
Yeah, just to add on to that a little bit. So for 2 U.S. citizen spouses, there's unlimited gifting. And I think a lot of people in the room are probably familiar with that concept. But in Japan, as you know, it's very difficult. Everything's all very separate. Even when it comes to bank accounts, you can't really open up a joint bank account necessarily. And so Japan doesn't have that the same rule. So there's that 1.1 million yen annual exemption. There's certain other sort of exceptions that they've also put in place, mostly around real estate. So I think the more common one that maybe people have heard about is if you've been married for 20 years, then you can gift up to your spouse up to 20 million yen in terms of with respect to a principal residence located in Japan. But just to clarify for everybody in the room, Japan doesn't have that same rule as the US where there's unlimited gifting between 2 US citizen spouses. So Japan is very, very much kind of a separate kind of state.
Another comment.
One question for you, Clayton.
Yes.
No, just out of curiosity, the form of Obamacare,
Yes.
you had the exemption that
Correct.
either you are contributing to the medical coverage you have and Japan qualifies, or you had that bona fide residence and physical presence.
Right.
Does it mean that you have to qualify for, or you must be taking a 9/11 exclusion? Because
No,
some
you
of
do
the-
not have to take the exclusion. It's merely the same requirements.
Okay. So you could not be taking the 9/11 exclusion, but still can qualify.
Correct.
Okay.
Okay, I think we have to...